Gaurav Kapur joins us, senior economist with RBS. Gaurav, what is your understanding? You know, we are getting excited with what inflation number we've got, but to my mind, it's meaningless. Reserve Bank of India will say, let's move on. The real problem is not the month of September. What will happen in the month of October?
Well, yes, I think you're right. I don't think even after yesterday's fuel price hike and at the same time a QE3, which is unlimited in nature, I was not expecting the RBI to do anything on Monday. Yes, now October has become that's something which we'll need to watch out for closely, because with 7.5 now, September, because of a base effect, the next number could pretty much will be between 7.5 and 8. So these are numbers which RBI will not be comfortable with, and I think on slightly away from the inflation, purely inflation numbers, I think the fact that the government has taken the first step towards fiscal consolidation and that too in a manner where they've introduced this cap on LPG for 6 cylinders every year. I think that's something shows that, you know, this will take some time to kind of start showing up in fiscal numbers itself. So even from that perspective, unless there is a follow-up action from the government in terms of cutting spending, and that's something which is being flashed on news wires a while ago, that there could be some measures which could be announced on Saturday in terms of cutting expenditure from the government side. I think unless you have a credible fiscal consolidation and on a sustained basis, RBI would be in two minds whether to go ahead with rate cuts. And I think now a 50 basis points cut is perhaps off the table, because with QE3 in place, and that too in unlimited nature, I think RBI would perhaps go back to calibrated form of rate cutting. Will they do a 25 basis points cut perhaps in between October and December, and perhaps another 25 basis points cut in the following quarter, because we were expecting 50 basis points cut over the second half of the fiscal. So I think with QE3 now, actually I think the critical thing which from RBI's perspective is QE3, because the previous two rounds of quantitative easing have only made things difficult for us in terms of pushing up oil prices. And in fact, I'm sure even this month's inflation number, there is a significant pickup on account of the increase in global oil prices between July and August.
Right. So Gaurav, what you're saying is that the next credit policy meeting will be more like a no-show, more like a hygiene and a routine event. We may not get anything.
That's if you're referring to September 17th, yes. October will be crucial because I think that's a mid-year review. So RBI would be taking into account the growth environment as well as inflationary expectations and conditions. So, and that is a more detailed review compared to what you see on Monday. So, and October we'll get to read what the RBI has to say in much more detail, and they typically tweak their forecasts on growth and inflation and give a forward guidance for the coming fiscal as well. So I think Monday would perhaps still be largely in line with consensus expectations of a no rate cut, but I think October will be a crucial decision from the RBI side in terms of deciding between whether they want to persist and continue with the hawkish stance which they have so far, or they want to start taking some degree of or they want to start factoring in the fact that growth has weakened and has perhaps and can stay below 6%, not even this year, perhaps even in the next fiscal for at least one quarter or so. So I think that's so October I think will be a more crucial policy to watch out for in terms of what the RBI has to say.
Gaurav, a consensus view on the street is that we should not get fixated with Reserve Bank of India policy action, because PSU banks, they've already cut their lending rates, they've cut their home loan rates, they've cut their car loan rates, which means we already have a rate cut in the system. And even if Reserve Bank of India, if they cut rates by 25 or if they do 50 also, it really may not kickstart the economy, because the investment cycle or a broken down investment cycle is not a function of high interest rates, it is a function of policy paralysis.
Yeah, that's something we've been saying for quite some time now, and that's something the RBI has now been clearly saying in the last couple of policies, that the slowdown in growth is on account of non-monetary factors, and monetary expansion, actually monetary conditions have become much more accommodative in this fiscal than they were in the previous fiscal. And as you pointed out, there already is some impact of the last, the cut in SLR which RBI did in the previous policy. So you do see some impact, and I agree. I don't think interest rate softening is the only or is the main driver to push up growth. It would definitely help improving to some extent leverage consumption, but I don't think it will significantly boost investment activity, because for that you not only need a much more much more certain domestic environment, you also need the global environment to be much more supportive, because the last investment boom we saw between 2005 and 2008 came on the back of fairly large capital flows into India, and that condition is clearly missing at this point in time. So it remains to be seen whether the QE3 really kind of brings in more money into India in form of equity flows or debt equity, basically portfolio flows. So if that happens, then that would be positive, because other than that, you've seen QE not really helping in case of India. So I think it's a mix of I think it's largely non-monetary policy factors which need to drive push up growth, right, than only purely interest rates.
Fair point. That was the punchline I was looking for. So yes, interest rates is one trigger, but it is not really the ultimate trigger when it comes to revival of the economy. I appreciate your time. Thank you for your quick thoughts.